Okay, everybody, we're back. So we are going to cover in this video how monetary policy impacts the overall economy, particularly in terms of the economic outcomes that we're looking at, that we're measuring. So by the end of this section, you should be able to compare and contrast expansionary and contractionary monetary policy, explain how monetary policy affects interest rates and aggregate demand, assess Federal Reserve decisions over the past 40 years, and then explain the significance of quantitative easing. So central banks, like the Fed, use monetary policy as a key tool to influence the broader economy, right? They mainly do that by adjusting interest rates to either encourage or restrain spending and investment. So let's start with expansionary monetary policy. When an economy is slowing down or they're facing high unemployment, central banks might lower interest rates to make borrowing more affordable. And that's often called loose monetary policy. It encourages businesses and consumers to take out loans for the spending and investment. It increases aggregate demand and it stimulates economic activity. So we get a little bit looser with our interest rates. On the other hand, when inflation is running high and the economy is overheating, it's going too hot, central banks might use contractionary monetary policy. That policy raises interest rates to make borrowing more expensive by raising those rates. So it discourages excessive spending. And this is known as tight monetary policy. It helps to reduce aggregate demand and it curbs some of those inflationary pressures that we see. Now, ultimately, these policies aim to keep the economy stable by influencing some of the key indicators like aggregate demand and unemployment and inflation. And so expansionary policies can boost economic growth while contractionary policies help to keep inflation in check. You can think of it like a car. When that car starts driving too fast, we got to pump the brakes. When it's driving too slow, we got to step on the gas. And that's what the Fed is really doing with these two types of policy decisions. So how does a central bank raise interest rates? It's not actually a direct action. It actually happens indirectly. So instead, what the central bank does is they change the bank reserves through open market operations. That then affects the supply curve of loanable funds, and it leads to changes in interest rates. So it's an indirect thing that they are doing, right? The target is the federal funds rate, and they use open market operations to target that federal funds rate. So since 1995, the Fed has always announced its target federal funds rate in advance of any open market operations. So if the open market operations don't achieve the desired interest rate, the Fed can then just adjust the supply of reserves until interest rates reach that target. So they're not really doing it directly, but they're doing it more indirectly through open market operations. This graph here is an excellent illustration of how expansionary and contractionary policy impact interest rates and the supply of loanable funds in the economy. So let's start to break this graph down, and I'm going to move myself over a little bit here. Okay, so the graph starts at an initial equilibrium point, which is labeled E up in the center there. Okay, it's labeled E there. So that's where the supply and the demand for loanable funds intersect with one another. You can see the supply curve, or sorry, the supply is a straight line, the demand curve is curving downward. All right, so that's the equilibrium interest rate, equilibrium point. Now, if the central bank decides to adopt an expansionary monetary policy, which is usually in response to some slow economic growth or high unemployment, well, then it increases the supply of loanable funds. So you can see how it moves down the supply chain moves down the supply line, right? That action is basically a rightward shift. I'm moving the wrong direction. A rightward shift from the initial supply curve S0 to the new curve S1. Now, as the supply increases, the equilibrium point moves to E1, which lowers the interest rates from 8% to 6%. Now, this decrease in rates encourages more borrowing and boosting spending and investment into the economy. Now, conversely, if the central bank is concerned about high inflation, it might use contractionary monetary policy to slow down economic activity. So that policy reduces the supply of loanable funds, which we can see in the shift in the supply curve from S0 to S2 over to the left. As a result, this equilibrium point shifts to E2, and you can see that that has raised the interest rates from 8% to 10%. So higher interest rates make borrowing more expensive, which dampens spending and investment. It helps to control inflation. So in practice, the banks use the federal funds rate as a target for these policies, these expansionary and contractionary policies. So when they make adjustments in the reserve supply, they're influencing this federal funds rate. And maybe they hit their target, maybe they don't, maybe they have to do more, right? So it just depends, but it's an indirect relationship. So what this allows, though, is that the central bank, it can steer economic activity to promote stability by carefully managing aggregate demand, unemployment, and inflation all at once. So they're really generally very good at this as well. Now, monetary policy is really important in shaping aggregate demand, right? So by influencing interest rates and the quantity of loanable funds in the economy, through these mechanisms, central banks can either stimulate or restrain that spending and investment. So when a tight or contractionary monetary policy is implemented, the bank is raising those interest rates. It makes borrowing more expensive. This directly affects two significant components of aggregate demand. One is business investment, and the other one is consumer borrowing. Higher interest rates make it less attractive for businesses to borrow funds for new projects or expansion. Sorry, I like to be over here. So higher interest rates make it less attractive for businesses to borrow money for new projects, for expansion. It leads to a decline in investment spending. Consumers are also less likely to finance big ticket purchases like buying homes, buying cars, buying appliances, because they need to borrow money to make those purchases, and the borrowing is now more expensive. So together, these reductions in business investment and consumer spending lead to a decrease in the aggregate demand. It helps to cool down an overheating economy and control inflation. Now, on the other hand, loose or expansionary monetary policy lowers interest rates. It makes borrowing cheaper. In response to that, businesses are more inclined to invest in some growth opportunities, and consumers find it easier to finance those major purchases, that house and that car that you've been wanting to buy. So that boosts business investment and consumer activity, consumer borrowing, which increases aggregate demand, and that then helps to stimulate economic activity, which is really useful during a recession period. So by adjusting those interest rates through monetary policy, the central banks can effectively influence the spending and the investment decisions that drive aggregate demand from businesses and consumers, and help stabilize our economy. Now, this graph here, it represents a visual of how expansionary and contractionary monetary policies impact aggregate demand in the overall economy. So I'm going to focus on the one on the left first. Let me move myself again. All right, so let's start with the expansionary monetary policy. In the graph here on the left, we see an economy initially at point E0, where real output is below its potential level, indicating that we're in a recessionary period. We may have some high unemployment. We're not producing what we should be. And so here, the central bank then steps in with an expansionary policy, typically lowering interest rates to boost investment. That then boosts the borrowing and the spending. It shifts the aggregate demand curve over to the right, from AD0 to AD1. As a result, the economy moves to a new equilibrium point E1, where output aligns with the potential GDP. So that shift comes with a modest increase in the price level, but it helps to bring the economy out of a recession with some minimal inflationary pressure. In the graph here on the right, we see the opposite scenario with contractionary monetary policy. So now suppose the economy is at E0, where output is at or above potential GDP, which means people are overworked, right? They're working so much. Maybe people are now having 2 jobs, right? We're producing more than what we really should be. Things are moving hot, okay? So that is what leads oftentimes to inflation. And so the central bank might choose to raise interest rates here, which discourages that spending and investment. And so that action causes a leftward shift in the aggregate demand curve from 80 to 81. It reduces aggregate demand. So the economy then moves to a new equilibrium point E1, where output falls closer to the sustainable long-term level. So that helps to lower the price level and it controls inflation. So these 2 policies, they help to illustrate the Fed's role in managing those economic fluctuations in the boom and bust cycle. Now, during a recession, the primary goal of expansionary monetary policy is to boost economic activity, bring the economy to its potential GDP, the level of output it can sustainably produce, and when resources are fully employed, right? We've talked about that when we talked about GDP. So in a recession, output is below this potential, which means high unemployment, unused capacity. So to counteract this, the central bank can lower those interest rates, making borrowing more attractive. Lower rates encourages businesses to invest, households to spend. It stimulates that demand in the economy, just like we talked about. When an economy is growing too quickly, it can overheat. It leads to rising prices, to inflation, right? The goal with contractionary policy is to curb inflation, stabilize price levels, bring the economy back down to its potential GDP, to that sustainable level of output that aligns with our full employment goals. So again, we're using those 2 policies to make these things happen. Now, there's something called a counter-cyclical monetary policy strategy, and that's designed to stabilize the economy by basically moving in the opposite direction of the business cycle. So this approach means that during economic downturns, monetary policy should aim to boost economic activity, while during periods of rapid growth and inflation, it should focus on cooling things down. Just as we just mentioned, during a recession, right, unemployment's high, economic growth is sluggish, central banks adopt an expansionary policy. Overreacting in an aggressive expansionary policy can lead to, inflation, and it can lead to unintended consequences. Excess demand may be pushing prices higher. So we have to be careful. It's a balancing act. The counter-cyclical policy, basically, it aims to provide a measured response to stabilize economic activity over time and to help promote sustainable growth without the extremes of inflation or recession. This here visual explains a little bit more about the expansionary and contractionary policies and how it affects aggregate demand on the overall economy. So here in part A, you can see that under expansionary monetary policy, the central bank increases the money supply, or M, making more funds available for borrowing. Now, they don't actually print money, but they can go to the Treasury and say, hey, we're going to put more money in the economy. The Treasury can then start to print money, and they can do the money printer, money go brr, right? So it's more of they're making more funds available for borrowing through their open market operations. This increase in the supply of money then lowers the interest rate, right? It's an indirect relationship, supply and demand. It lowers the interest rate, and that encourages borrowing from businesses and consumers, which is the investment and consumption, I and E and C on the curve. Those both rise, which then shifts the aggregate demand curve to the right. This rightward shift leads to a higher price level, P. So also leading to an increase in real GDP, at least in the short term. So the overall effect is an economic stimulus that boosts growth, and that's really useful for combating those recessions. Now, in part B, in the next part, we see the opposite effect with contractionary policy. So here, the central bank reduces the supply of money. They reduce the available credit, which raises the interest rate. Higher interest rates discourage borrowing for both investment and consumption, which leads to a leftward shift in the aggregate demand, and that then reduces the price level as demand falls, and it lowers real GDP, at least temporarily, back to sustainable levels. So Let's take a look at some of the historical developments that we've seen, some of the things that the Fed has done and what monetary policies have taken place. We categorize these into episodes. So we'll start between the 1970s and 1990s. The Federal Reserve implemented several significant policy changes in response to various economic conditions at the time. So in episode 1, 79 to 81, there was double-digit inflation rates, above 10%. And so Federal Reserve adopted a strong contractionary policy under Chairman Paul Volcker. The federal funds rate was aggressively raised to around 16%. I think it even reached a high of 20%. But it made borrowing far more expensive. I mean, you imagine interest rates at 16 or 20%. It was a sharp increase in rates, and that's, and it made borrowing more expensive. I'm going to show a video here about this episode so you can understand a little bit more of the background. But it was really a crazy period in our economic story. But that sharp increase in rates helped to successfully curb inflation. It did lead to 2 recessions in the early 1980s. So there was a difficult trade-off there between controlling inflation and maintaining economic growth. But today, when we look back, even though those decisions were hard and they were deeply unpopular, no elected official would have done what Paul Volcker did. So today we look back and say, he did what he had to do, and we have had a more sustainable economy ever since then in the last 30 years as a result of that. Now, in episode 2, in the early 1980s, we saw inflation starting to fall. The Fed shifted to an expansionary policy to address high unemployment and to stimulate the economic recovery. So interest rates were then lowered to about 6.8%, which still sounds high today, but from where they were, they lowered to about 6.8%. Now that made borrowing cheaper, it encouraged spending and investment, and it helped that helped reduce unemployment and brought us back to stability. In the late 1980s, in episode 3, inflationary pressures were rising again, which prompted the Fed to again adopt a tight monetary policy. They raised interest rates to 9.2%, right? And then that ultimately contributed to another recession, 1990 to 1991 recession. So when we do these tight monetary policies, they often end up in a recessionary period because you're putting on the brakes on a hot economy. So when we talk about a soft landing with the COVID-19 pandemic and that recession, that soft landing is respective of, we experienced high inflation, but we didn't enter another recession as a result of the monetary policy decisions that we made. We avoided another recession. Not to say that we weren't in one during the pandemic, but that was a very short-lived recession. All of the inflation happened after that recessionary period. And so what happened in the years following is we did not enter into another recession, at least up until this point. So we're still in that soft landing phase. Now, in the early 1990s, the Fed once again turned to expansionary policy. Again, interest rates were lowered, they stimulated growth, they reduced unemployment, and then by 1997, the unemployment rate had actually fallen below 5%. So they had a successful recovery, they returned to some stability. All right, so I mentioned that I had a video about the inflation from the 1970s and the work that Paul Volcker did in controlling that inflation. This is worth watching. I will let you watch this on your own time. I'll keep this video a little shorter by not playing it, but I highly recommend taking a look over on this video. It's really informative. It also explains a lot about what the Fed's powers are. So moving further, in the 2000s, we entered, in the 1990s, we entered episode 5 and episode 6 between 99 and 2000. And so during the expansion period of the mid-90s, and again at the end of the decade, the Fed raised interest rates in anticipation of some potential inflation. So these rate hikes were really intended to prevent the economy from overheating as growth was accelerating. A lot of this then helped to maintain price stability, but the overall impact on economic activity was kind of minor. Then we have the 2001 recession. That wasn't really a failure of monetary policy. That was the bursting of the dot-com bubble, but that prompted the Fed to then reverse course and implement rate cuts to help stimulate recovery. They didn't really had not really planned on doing that. Now, in the early 2000s, we entered the episode 7. So that was in response to the dot-com bubble burst in the 2001 recession. We adopted this highly expansionary policy. We lowered interest rates pretty aggressively to what was at the time historically low levels, reaching 1%. So that policy was aimed at avoiding deflation and encouraging borrowing and investment to jumpstart the economy. In episode 8, 2004 to 2007, that was a period when the economy was strengthening. The Fed began a gradual series of rate increases starting in 2004 to prevent inflationary pressures. By 2007, the federal funds rate had risen, marking the end of that extended period of low interest policy. And so those were all intended to normalize our rates, get us back to a base level, and to help kind of prevent these economic imbalances. So that then now takes us to the Great Recession. So that was the most severe economic downturn in recent history. It led the Federal Reserve to take some unprecedented actions to help stabilize the economy. As the recession deepened, the Fed rapidly cut rates. They reduced the federal funds rate to near zero, all right, and they reached that threshold, which you can't go negative, so they had to get creative. The aggressive moves that were aimed to lower the cost of borrowing as much as possible. We wanted to encourage consumer spending, encourage business investment to help counteract that sharp decline. We ran into that zero bound problem. So when the conventional open market operations started to be constrained by the zero bound interest rate limitation, the Fed turned to non-traditional policy tools to continue providing economic support. So one of those tools was quantitative easing, where the Fed purchased large quantities of long-term government securities and mortgage-backed assets to inject liquidity directly into the financial system, put money into banks. That then increased the supply of money. It supported lending. It helped keep the long-term interest rates low. And additionally, the Fed introduced forward guidance, which is a communication of its intent to keep interest rates low for an extended period of time to help reassure that the markets that they were going to stay low. We wanted to stabilize expectations. It was all a mental tool, really. So those were some non-traditional approaches that we took. Now, in the movie Too Big to Fail, we saw a clip of this with Paul Bernanke earlier in this section, in this series of videos. But this is a different clip from the movie Too Big to Fail. And I think it's a really interesting one because it's going to help us kind of understand the context a little bit more. But in this scene, Hank Paulson presents TARP. TARP was the Troubled Asset Relief Program, and he's presenting it to the heads of major banks. And it really captures a really important moment during this crisis. This meeting was a reaction to the urgent need to stabilize the financial system as banks were on the brink of collapse due to massive losses on the mortgage-backed securities and the other risky assets they held. Now, Paulson is the United States Treasury Secretary, and he's explaining that TARP is going to inject capital into those institutions by buying stakes in them. Remember, we were already doing quantitative easing. We were already lowering interest rates to near zero. This was injecting more money into the banking system by literally buying ownership shares in the banks. It helped to provide them with emergency funds to prevent a collapse that could bring down the entire economy. And you're going to see in this clip, some of the banks didn't want it, didn't need it. They were fine. They were healthy. They didn't have as much of a risk exposure. But the fear wasn't any one bank was going to be fine. The fear was if you have one bank fail, which we did, you'll have another bank fail and another, because people will do a run on the banks like they did during the Great Depression, and it will chain react. And even though we have FDIC, we're talking large amounts of money, it will chain react and banks will fail after fail after fail. Now, I'm going to let you watch this and we'll come back and talk about it because this is really important.
Wix.
We are of the view that
The United States needs to take strong, decisive action to arrest the stress in our financial system. Through our new TARP authority, Treasury will purchase preferred stock in each of the banks represented in this room. That stock will yield 5% the first 5 years, 9% after that. We give you money, you lend it out. It will unfreeze credit, stabilize the banks, restore confidence. Everyone will be better off with more capital in the system, and that is why all 9 of you will participate in the program.
Some of us don't need any capital.
You all need capital. You have no idea what the market's going to look like in a year.
Neither do you. I'm not one of you New York guys with your fancy products. Well, why am I in this room talking about bailing you out?
The stronger banks will serve as cover for the weaker banks. If just some of you take it, the money is a signal that a bank is too weak to survive. The market will devour it.
How much are we talking about? 125 billion. Bank of America, 15 billion. Bank of New York Mellon, 3 billion. Citigroup, 25 billion. Goldman Sachs, 10 billion. JP Morgan, 25 billion. Merrill Lynch, 10 billion. Morgan Stanley, 10 billion. State Street, 2 billion. Wells Fargo, 25 billion.
What happened to buying toxic assets? Wasn't that the idea?
It's too slow. He'll be dead before we sort it out.
So we're just handing the reins over to you?
Deal's actually pretty good. You turn your nose up at this now and we have to rescue you later, the terms won't be nearly as attractive.
It's cheap capital. It's not the worst idea in the world.
Well, just for those of us who already have capital.
We will be non-voting shareholders. This will be a temporary measure.
What if we decline to be involved?
The chairman of the FDIC is sitting right there. Tomorrow you'll find out you're not as well capitalized as you think you are.
What kind of protections can you offer on changes for compensation policy? I mean, if the government is going to become a part owner, does that mean that the government is going to dictate compensation?
You're asking me about your bonus right now, John?
I'm running a company. If the Fed tells me I can't offer competitive pay for talent, you're going to launch the biggest brain drain this country's ever seen. Is that the way you want to run the banks?
Until the money is repaid to the Treasury, there will be some limitations on tax deductions and golden parachutes.
Well, there you go.
I don't really understand why there needs to be so much tension about this. The country is facing the worst economy since the Great Depression. If the financial system collapses, it will take every one of you down.
Give me the papers.
You can't just sign it.
Oh, no?
Not without your board.
My board's on 24-hour notice. I think they'll go along with it. And if they don't, they'll fire me.
Anyone else?
So something I want to be really clear about. TARP is a fiscal policy measure. It involved the direct spending by the United States government to stabilize the economy, managed by the Treasury and approved by Congress. However, it went hand in hand with monetary policy, as seen by the presence of the Federal Reserve's officials in the room, right? You had the Fed chairman and you had the FDIC chairperson in the room. So the Fed had been using monetary tools like lowering interest rates and initiating its own emergency lending programs and doing the open market operations and quantitative easing, did all of those things to keep the financial markets afloat. But the scale of the crisis required both fiscal and monetary intervention. So monetary policy alone was not really enough to prevent bank failures or to restore solvency. All right, that brings us up to more of a present day with the episode 10, the COVID-19 recession in March 2020. We've already talked a lot about this, but basically in response to that very severe, quick recession, the severe downturn, the Fed reduced the federal funds rate from 2%, because it was slowly raising it from 2008 crisis, to 2%. It went back down to between 0 and 0.25%. So they had to bring it back down. They hit that floor again. They also decided to do some more extraordinary measures, like the more expansive quantitative easing, more of their using the emergency lending powers that they have. They did more of this forward guidance to say to the markets, this is what we're going to be doing for a while. A lot of the same things that we just saw during the 2008 crisis. They learned a lot from 2008 that then went into managing the COVID-19 recession and the soft landing that we have been targeting since then. So through all of the episodes, you can see here how they interacted with one another and how the Federal Reserve reacted to the higher inflation with both contractionary monetary policy and higher interest rates, to higher unemployment, and with expansionary policy for a lower interest rate. And you can see how that has shifted. Now, again, if we take a look back at the 1970s, this was a period when they made some deeply unpopular decisions. People were protesting. If you watch the video I linked, you'll see some of the protest moves that they made. But in the decades since then, we have seen stability, relative stability, compared to the record high inflation during the 1970s. We have not really even come close to this level of inflation since then. Even though the pandemic had high inflation, it was not 1970s high. And so this is really representative of those hard decisions that the regulators have to make. And if they don't make those decisions, it does not instill confidence into the marketplace. Now, in our next video, we are going to finish this chapter out and we're going to cover the pitfalls of monetary policy. So I will see you in that one.